Welcome back to the Deep Dive. Our mission, as always, is to take these complex financial reports, these strategic updates that land on your desk, and really break them down into clear, actionable insights for you. And today, we're diving deep into Cardinal Health. We're looking at their Q1 fiscal year 2026 earnings and, importantly, some pretty bold strategic moves they announced right alongside those numbers.
Yeah, and if there's one big takeaway, one sort of narrative thread running through all this source material, it's really about acceleration, a huge acceleration.
Okay.
Cardinal Health reported, a tremendously strong start to their fiscal year. You've got profit growth basically everywhere, every single operating segment, and critically, they've substantially raised their earnings outlook for the whole year.
A strong start indeed. Okay, let's unpack that momentum right away. But maybe just a quick pause before we hit the big numbers. These are the non-GAAP figures we're focusing on, right?
Yeah.
The year-over-year increases.
That's a really good point to clarify, yeah. For anyone listening, non-GAAP numbers, well, they're generally what the market focuses on. They kind of filter out the noise, the one-time charges, maybe some write-downs.
Right.
So it gives you arguably the clearest picture of how the core businesses, the day-to-day operations, actually performed. And those core businesses, they are absolutely flying.
Flying seems about right. Total revenue hitting $64 billion. That's up 22% compared to last year.
22%.
Huge. And operating earnings soared to $857 million, which is up, what, 37%?
They're massive 37%, yeah.
And then the one investors really track, the diluted EPS, earnings per share, that came in at $2.55. Another big climb, 36%.
And what's really interesting, I think, is that this isn't just one part of the business carrying the load. The strength is really broad. It seems to be driven by, well, good execution on their strategic priorities, obviously, but also operational momentum pretty much across the board, all 5 segments, and a real focus on expanding in specialty solutions.
Specialty solutions, right. Often higher margin than the traditional distribution side.
Exactly. Which leads us perfectly into the biggest piece of their pie, the Pharmaceutical and Specialty Solutions segment, pharma as they call it. That's the engine.
It really is the financial engine, isn't it?
Absolutely. It just continues to dominate. For Q1, pharma revenue was $59.2 billion. That's up 23%.
Another huge jump.
And the segment profit, the bottom line for pharma, increased 26% to $667 million just in the quarter.
Okay, so where's that profit boost coming from specifically within pharma?
Well, it's kind of 2 main areas. You got the traditional strength, the performance from brand name drugs and generics. That's always been core.
Sure.
But increasingly, it's coming from their investments in these MSO platforms.
MSO, okay, we've seen that acronym pop up a lot in the sources. I think they even called MSOs their secret sauce at one point. But for you listening, what exactly is a managed service organization, and why is owning one, better for Cardinal Health than just being the delivery truck for the drugs?
That's really the critical question here. Think of MSOs as essentially the back office, the business management arm for specialty doctor practices.
Okay, like oncologists or urologists?
Exactly those kinds. The MSO handles everything non-clinical, the billing, the HR, purchasing supplies, patient data management, all that stuff.
I see.
So by buying and running these MSO platforms, Cardinal Health isn't just, dropping off boxes of drugs. They're becoming the essential operational partner to the practice itself, the high-value specialty practice.
Ah, so it sort of locks in the customer much more deeply than just distribution would.
Precisely. It creates a much stickier relationship and typically a higher margin revenue stream, too. That's the form of vertical integration, really.
That makes a lot of sense. And we saw the impact right away this quarter, didn't we? Their existing MSOs, GIA and ION were mentioned.
Yeah, GIA and ION. They contributed about 8 percentage points of the pharma segment's profit growth in Q1 alone, so a significant chunk.
8 points just from those existing platforms.
Yeah.
Wow.
And now they're doubling down. They're really cementing this strategy with their newest planned acquisition, Solaris Health.
This looks like a huge move, really aggressive. Solaris Health, the source material says, is the country's largest urology MSO.
That's right, the largest. It brings in over 750 providers, doctors mostly, across more than 250 locations in 14 states.
Yeah.
It's a big network.
So when this deal closes, their combined MSO group, they call it the Specialty Alliance, I think.
Yep, the Specialty Alliance.
That alliance will reach roughly 3,000 community providers across, 32 states?
That's the projection. It gives them a massive footprint in community specialty care. The price tag, though, is substantial.
It certainly is, approximately $1.9 billion in cash.
Right.
plus another, what, $500 million estimated in common units and share-based pay for the doctors and managers involved?
That's right. So a total consideration well over $2 billion.
That $1.9 billion cash outlay especially seems huge, given where interest rates are, and Cardinal already has some debt on its books. Is this maybe too aggressive? Or is that projected specialty margin really worth taking on that kind of debt risk right now?
That's the million-dollar question, isn't it? Or rather, the $1.9 billion question. It's the core strategic tension. They are making a very, very aggressive bet. The bet is that the stickiness, the long-term profit margin from these MSO services will more than outweigh the financing costs involved in buying them.
Okay.
And you mentioned debt. It's also important, maybe vital, to remember that big long-term financial issue that's always kind of anchoring their balance sheet.
You mean the opioid settlement liability?
Exactly, that $4.3 billion accrued liability from the national opioid litigation settlements. Even with all this profit acceleration we're seeing now, they still have that long shadow. Payments stretch out to 2038 mostly.
Right.
And that has to act as a constant constraint, on their capital deployment decisions. It just has to be in the back of their minds.
So, okay, despite that huge long-term obligation, they feel confident enough in the specialty MSO path to make these massive cash acquisitions now. Interesting.
Very.
Now, before we leave the pharma segment entirely, there was a really surprising detail, I thought, related to, current drug trends. The GLP-1s.
Yes. The weight loss and diabetes drugs. Everyone's talking about them.
Exactly. The source material noted their explosive growth.
It's a fantastic point to bring up because it really highlights the crucial difference between revenue and profit. I mean, I imagine everyone listening probably knows someone taking these drugs or trying to get them.
I seem to be everywhere.
They are everywhere, and that's been great for Cardinal Health's top line, their revenue.
Oh, great. What did the sources say?
GLP-1 sales accounted for about 6 percentage points of the entire pharma segment's revenue growth. 6 points.
Wow.
That is a tremendous amount of product volume flowing through their distribution system. But, and this is the key nuance you really need to grasp, despite that massive revenue number, those increased GLP-1 sales did not meaningfully contribute to the segment's profit.
So high volume but low margin for the distributor.
Precisely. As just the distributor, they move the product, they get a slice, but it's relatively thin. The real profit, the fatter margin, comes from the more specialized distribution, and especially those stickier integrated MSO services we just talked about.
Okay.
So yeah, the GLP-1 volume looks impressive on the revenue line, but it doesn't drive the bottom line nearly as much as those strategic specialty gains do.
That's a really important distinction, a true aha moment that probably gets lost if you just read the headline revenue figures.
Absolutely.
Okay, let's shift gears a bit. Operational improvements. We should talk about the Global Medical Products and Distribution segment, GMPD. This part of the business has been under an intense turnaround plan, right?
It has. It's been the focus of their improvement plan initiatives for a while now, and, we are definitely seeing some dramatic results this quarter.
Dramatic how?
Segment profits surged. I mean, it went from just $8 million in Q1 last year, fiscal 25.
Tiny. To $46 million this quarter.
Whoa. From $8 million to $46 million in profit. That is a massive jump. Is this like a sustainable trend, do you think? Or was it just a one-off blip, maybe some big orders they managed to capture?
Well, the report suggests it was primarily driven by volume growth from existing customers, which, that does suggest some solid operational stability returning.
Okay, that's positive.
It is. However, they are also pretty quick to point out that this segment, GMPD, it's still exposed to those inherent global sourcing challenges, supply chain risks.
Right. Things like tariffs, finding reliable alternative suppliers.
Exactly. They specifically mentioned recent tariffs and just the difficulty, the time it takes to establish alternative supply sources quickly. So yes, they're executing the turnaround, the numbers look way better, but the overall supply chain environment is still, let's say, volatile. There's still risk there.
Understood. Okay, so beyond the two huge segments, pharma and GMPD, there's that other category. What's in there again? Nuclear and precision health, at-home solutions, OptiFreight Logistics. That's the basket, yeah.
Yeah.
Usually kind of flies under the radar a bit compared to the big two.
Right. But this quarter, it had an exceptional performance, didn't it?
Exceptional is definitely the word. The other businesses really accelerated. Q1 revenue up 38% to $1.6 billion.
38% revenue growth. Strong.
And the segment profit, it jumped an unbelievable 60%. 60%. to $166 million.
60% profit growth in one quarter. That's remarkable. What drove that? Was there one single factor? Like, was it the logistics side booming, or maybe that push into at-home care?
It seems to be a mix reflecting alignment with strong secular trends.
Yeah.
Big shifts in healthcare, like care moving into the home.
Right, telehealth, home delivery of supplies.
Exactly. Plus, leading market positions in those niches and just focused, successful execution on their investments.
Yeah.
They did specifically call out the successful integration of ADS,
ADS.
Advanced Diabetes Supply. That falls within their at-home solutions business. Integrating that smoothly seems to have been a key factor in that profit jump.
Oh.
So it really shows they're focusing on moving into these sort of high-growth, future-facing fields. And it looks like those investments are validating the strategy even outside their traditional core distribution business.
Well, with performance like this pretty much across the board, pharma strong, GMPD improving dramatically, others accelerating, it's really no surprise they're signaling major confidence for the rest of the year, is it?
Not at all. It leads directly into their updated full-year guidance.
Let's look at that. What are the new expectations?
They significantly raised them. Non-GAAP diluted EPS guidance, earnings per share for the full fiscal year 2026. That's now expected to be between $9.65 and $9.85.
And that's up from what range before?
Up from the prior range of $9.30 to $9.50. So a decent bump.
Okay. And what about cash flow?
Also raised. The outlook for non-GAAP adjusted free cash flow is now between $3.0 billion and $3.5 billion for the year.
And this ties directly back to that aggressive specialty focus we've been talking about, particularly the Solaris deal.
Exactly right. They stated pretty explicitly the raised full-year pharma profit guidance. They now expect 16% to 19% growth in pharma profit for the year. That raise is driven directly by the Solaris acquisition. They figure that deal alone, once it closes and integrates, will contribute roughly 3 percentage points of profit growth to that key pharma segment.
So they're basically banking on Solaris contributing significantly right out of the gate or soon after.
Seems like it. It underpins that confidence in the raised guidance.
Now, to fund this massive acquisition, we know they took on more debt. They issued, what was it, $1.0 billion in new debt notes back in August.
Correct. $1 billion in new notes,
Yeah.
a mix of 2030 and 2035 maturities.
So how did that M&A activity, buying Solaris, change their outlook for financing costs? Did interest expenses jump?
It did raise the cost of doing business, yes. Their outlook for interest and other expenses was increased by about $50 million for the year. It's now expected to be around $325 million. That directly reflects the higher financing costs tied to the Solaris deal funding. Now, they did balance this a little bit. They paid off a $500 million debt maturity that came due in September.
Right.
But net-net, the overall debt stack definitely grew to make this MSO expansion happen.
Okay, so they're investing heavily in growth via M&A, funding it partly with debt. But at the same time, are they still focused on returning capital to shareholders? That's often a key sign of management confidence, isn't it?
It is, absolutely. And yes, they are. They actually initiated a $375 million accelerated share repurchase program, an ASR, during Q1.
An ASR. That's basically a way for them to buy back shares really quickly, right? Faster than open market purchases usually.
Exactly. They contract with an investment bank, give them the cash, and the bank delivers the shares almost immediately, effectively retiring them faster. It signals confidence in the current share price and future cash flow.
So they're using some of that expected future free cash flow to reduce the share count right now?
That's the idea. And the overall effect was tangible already in Q1. The diluted weighted average shares outstanding to the denominator, the EPS calculation, it decreased 2% year over year, specifically because of these share repurchases.
Interesting. So it's really a balanced story they're telling. On one hand, aggressive growth through M&A funded partly by new debt. But on the other hand, projecting aggressive profit growth from that M&A and immediately returning capital to shareholders through buybacks.
That sums it up pretty well. It's a strategy with multiple moving parts, but a clear direction.
Which brings us, I think, to our final synthesis.
Sure.
If you had to boil this whole report down, the core theme seems unmistakable, doesn't it? That strategic decision made some time ago to really emphasize specialty solutions, to aggressively accelerate these higher margin growth businesses, it seems to be translating directly into strong financials now.
I agree completely. And it's showing up not just in the numbers, but in the confidence reflected in that raised outlook.
Yeah.
The stabilization we're seeing in GMPD is, frankly, probably a relief for them. But the accelerating specialty MSO strategy, that feels like the real narrative here.
Yeah.
It really paints a picture of a business model they're building that's designed for, well, resilience, yes, but also for expansion in very targeted, high-value areas of the healthcare supply chain, beyond just basic distribution.
So thinking about that trajectory, given their increasing investment in these specialty MSO platforms like Solaris in urology, and at the same time, you have this surging but ultimately low margin demand for very high cost branded drugs like the GLP-1.
Two powerful trends converging.
Exactly. So here's the provocative thought for you, the listener, to chew on. How might that structural link the connection between major distributors like Cardinal, the specialty providers they now increasingly own or manage via MSOs, and the actual pricing of pharmaceuticals? How might all that evolve in the U.S. healthcare system over, say, the next 5 years?
That's a big question.
It is. Will these MSOs just become sort of vertical funnels that consolidate power even further for the distributors and maybe influence pricing indirectly? Or is this strategy creating new kinds of complexity around pricing and access that maybe we hadn't even fully anticipated yet?
A really critical question to ponder, especially as these specialty channels become the main pathway for more and more high-cost, complex therapies. It changes the dynamics.
Indeed. Okay, you've got your assignment to think about. Time to dive deeper on your own.
Definitely food for thought.
That's all the time we have for this deep dive. Thanks for joining us, and we'll see you next time.